Welcome back to the channel, everyone. My name's Andrew, and this channel is about entrepreneurship, personal finance, and the psychology of money. Today we're talking about, you guessed it, ways to avoid paying the government money, or retirement accounts. Stick around. So if you're anything like me, or most Americans for that matter, or people in the world, depending on where you're watching this, you haven't really thought that much about retirement. Either life's been busy, or you haven't had time to set up an account for yourself, or things just get in the way. You know, it's easy to say, I'm gonna do it tomorrow, and tomorrow turns into next week, vice versa. But today I'm gonna let you know that if you want to retire as a millionaire, one of the first things you need to do is set up your retirement account. The three most common types of retirement accounts are 401ks, IRAs, and Roth IRAs. Some employers also offer something called an HSA, which is a health savings account that is less common than the others, but still beneficial. The most important thing is that you utilize whichever program your employer offers or whichever program you need to set up for yourself if you're a sole proprietor or a 1099 employee working on your own independently. So you might be telling yourself, Andrew, why do I need a retirement account? You only live once, so I'm gonna spend my money as it comes in and I'll worry about retirement later. That's what Social Security is for. Well, if you want to be living in low-income apartments or in not the best area or not be able to provide for yourself, your family, your children, your friends after you turn age 60 or 65, then yeah, do that. That's a great plan. Pass the buck. Someone else will take care of you, maybe, or maybe the government will take care of you, or you'll just hang around. But if that's not what you want to do and you want to have money for medical emergencies, money for your house payments if you still have a house, car payments, things like that, money to live, then you probably should set one of these accounts up. Planning ahead for the future is one of the biggest key steps you can take to having a more enjoyable life, a happier life, and a better life for you and your family. By planning ahead, you're taking away most of the uncertainty that these people experience when they hit 40, 50, whatever age, and realize they've only been contributing a little bit or nothing to a retirement account. And all they have is a Social Security, potentially, if that program still exists when we retire. Optimistic, I would like my money, I paid into it, I'm sure you would too, but we'll see what happens. Your first step would be finding out what type of retirement account plans your employer offers. You can do that by potentially checking your employee handbook or asking your HR department or payroll if they offer anything like a 401k, an IRA, or an HSA. You may already know about these programs if your employer offers it, but if not, the first thing you want to do is ask which ones they offer and if there's a company match or an employer match. What that means is for every percentage or dollar of your salary that you contribute, your employer will either match that or contribute more than that to your account, meaning you're really getting free money. This is why I would recommend contributing to these plans before paying off some debts, depending on the rates, because this money is literally free money. If you're contributing 1 or 2%, but your employer matches up to 5%, you're missing out on free money there. And I, for one, love free money. I'm assuming that you do too. So do you like free money? Do you like free money? Because I love free money. It's probably my favorite thing. If I got free money every day, I'd be a very happy camper. I'm already pretty happy, but no one's giving me free money for the most part. Well, that is except for my employer, because they match my retirement accounts. That's why I'm recommending you sign up for one of these or set it up. Talk to your payroll department, talk to HR, find out, do they offer a 401k? Do they offer an HSA, an IRA, a 403b? Really, the list goes on and on and on. There's quite a few different types of retirement accounts depending on your employer, and you want to make sure that you're enrolled in at least one of them, if not more, and that you're getting the company or employer match, meaning they're meeting every dollar up to a set level that you put in, your company will match that, basically giving you free money every day. And the interest on that account is tax-free. It's a retirement account, so the federal government allows you to put money or other assets into there, bonds, stocks, cash deposits, things like that, to offset any kind of tax burden that you'll have during your working years to wait until you're older, potentially retired, and allows you to take that money out and use it for expenses. Imagine each of these different types of accounts is a container, if you will. You can put different kinds of things in that container. So we'll start with 401k. In 2020, the max contribution you can make to your 401k is $19,500. Now, I talked about free money earlier, and this is where that comes in. On top of that $19,500, your employer can match a percentage of your total salary or a percentage of that amount. When they match, that means they're contributing that amount to your 401k in addition to that max that you can contribute. So any money up to $19,500 and past, they can match that up to, I believe, a total of like between $50,000 and $57,000, depending on the year, between you and your employer. Your individual max however, is 19.5. Now, a 401k can be filled with different things. You can put exchange traded funds, or ETFs. You can put a variety of stocks, bonds, mutual funds, and sometimes real estate assets or other investments. Sometimes like an REIT or something like that, which would be a real estate investment trust, which is a variety of different real estate holdings all put together. Now that container that you have your 401k in, that we talked about visualizing, is a shield. So imagine that little box and you're protecting that, and you don't want the government to get their hands on it because you don't want to pay taxes on any of that stuff. And the government actually encourages this. That's why they set up these accounts. The US tax law is massive, and I think it's like 23 or 26,000 pages, and it's designed to help you. The people who primarily benefit from it are the wealthy, the business owners, and the upper class. That's because the middle class and lower class doesn't have time to read 26,000 pages of text to find out what kind of tax strategies and what kind of investment strategies or retirement strategies are going to be the most beneficial to them. So my goal is to try and simplify down some of those small portions of tax law to incentivize you to save money, to invest in yourself, and to say, you know what, this isn't just for the rich and the business owners to get wealthy. This is for me to help myself. This is for me to help my family. That's my goal here. If you enjoyed this content, consider liking and subscribing, and we'll keep going over personal finance information. I'm happy to help. Let me know if you have any comments down below on video topics or questions that you have. I'm happy to answer them. I'm doing this for you guys. Another type of retirement account is an IRA, or individual retirement account. There's also a Roth IRA, but we're going to talk about that in a different video. So your traditional IRA is an employer-provided plan that allows you to contribute money to stocks, bonds, other investments, pre-tax, meaning that this money is taken out of your paycheck before the federal government gets their little hands on it. I don't want them taking pieces of my money, pieces of my cheese. And as much as you can contribute to that, I would encourage you to. I believe the cap in 2020 is $6,000. Every couple of years, the federal government evaluates that and sees with inflation and amount that people are spending what the appropriate amount for you to be able to save or invest in those accounts is. Each year, you can contribute that amount. And through the power of compounding interest, that money will make you a millionaire if you start saving today. I promise you. So if you're 18 and getting your first job, or you're 30 and you're thinking about maybe I should start saving for my future, today is the right day to go and set up an IRA either at your employer or an outside agency if they don't offer them. I'd recommend Vanguard, I'd recommend Fidelity. Those are two brokerage services that offer IRAs. Your first goal with any of these accounts is to get the employer match. So if your employer offers a 401k, an IRA, and an HSA, but they only match on the 401k, then you're going to want to contribute money to the 401k before even thinking about contributing money to any of the other accounts. Your first goal is to get that match, that free money with compounding interest. If your employer offers matching on both your IRA and your 401k and HSA, if you're amazingly lucky, you should contribute as much as you can to every single one of those, prioritizing whichever account has the highest match first. Check with your employer in payroll or your employee handbook to see what programs they offer and ensure that you're getting the most free money possible out of these retirement programs. The last type of account we're talking about is an HSA, or a health savings fund. It's a program that your employer contributes a set amount to, and that you are also able to contribute a set amount to. I believe the contribution limits were around $6,000 for 2020. This is an account that I actually used to have. So whenever I would have medical expenses or things come up like that, if I hadn't met my deductible, honestly, I was in my 20s, so I usually had less than $600 of medical expenses per year, and that's what my employer matched. So I was able to use that account to cover my physical, some meds if I got a cold or a flu or something like that. And I was able to do that without taking any money out of my pocket. So that was free money, essentially, that my employer gave me for having a healthcare plan that also gave me money on top of that. So I paid into it, they gave me some money on the back end, and I used that money for my expenses. It was a really good program, and many people use those as investment vehicles, meaning instead of using the HSA for just medical expenses, they use it primarily as a way to save money for their future or their retirement and pay for medical expenses out of pocket. So that $6,000 each year compounds. Every year you add another $6,000 to it. Those can be invested in a variety of different stocks, investment accounts, things like that. Depending on your HSA and your employer, they usually have control over that. I myself have had a Roth IRA, an IRA, an HSA, and a 403b all at different times. Now, when you separate from employment from different employers, sometimes you're allowed to roll over those accounts to different places, or you're allowed to combine them, and I've done that a couple different times. But what I'm telling you and trying to share is that having a variety of retirement accounts and a variety of investments in them is never a bad idea. By diversifying your different investments, your different portfolios, you're preparing for the future, and you're preparing yourself against any kind of, unemployment or financial hardship. That money's supposed to be for retirement and it's supposed to stay there, but if you ever have an emergency, like you're going to be homeless or have to spend some money on my retirement, then it's probably beneficial to use some of that money from your retirement. This is my challenge to you. The next day you're at work, go to your HR department, go to payroll, check your employee handbook, and find out exactly what retirement accounts your employer offers and how much they match for each one of those accounts. Make sure you're getting that free money. Grab it. Grab that free money. Don't leave it on the table. That's money that your employer is just trying to give away to you. Please take it. Here, this is for you. We don't want it. And you're not capitalizing on it, or you don't even know if they're offering it? Come on. It's the least you could do for yourself and for your family and for your future. Go check. Find out what they offer. Let me know what you find out down in the comments. I'm interested in what your employers are offering and what kind of matches they're offering. You owe it to yourself, you owe it to your family. Go and get this money. It's gonna help you, it's gonna make you feel more secure, and it's just leaving money on the table. You wouldn't say, I don't need that. I'm not gonna walk by $20, $30, $40 on the ground, right? So why would you do that for your future? Why would you leave hundreds, if not thousands of dollars on the table by not checking into this? Look into it. Let me know how it goes. Let me know what you find out. And I'll see you next time.